Good morning, everybody. This is a part 2 on the D Operandi strategy. First of all, I'd like to salute Mr. D Operandi. His name is actually not D Operandi. It's Brian. I can't pronounce his last name. Let's just leave it at Brian. Say something begins with an S. And this is just a walkthrough of how I see that he does his thing. The reason I'm making this video is not because I'm trying to send you people to go and, follow him. I'm just trying to take some of the heat off of what he does and let you know that what he does, if you have basic understanding of how the Forex market works, it makes sense. It makes sense if you know what you're doing. It is very, very important that if you're going to trade a system or a strategy, it needs to make sense to you. So first things first, before we get into anything, we need to first acknowledge that when trading D Operandi strategy, we need to have leverage, high leverage of probably 1:500 or more. 1:500 or more. I prefer 1:500 because it's just something I'm comfortable with. You have to pick what's comfortable for you. You might want 1:1000, 1:2000. That's up to you if you're advanced and you know what the hell you're doing. But it's good to start with like a 1:500. You will still make a lot of money, and you need capital, right? Let's say you have $200. Everybody can afford $200. Let's say you have $200 you want to start trading with. You have $200 you want to start trading with. I advocate that you divide this $200 into sample sizes, okay? Sample sizes of about $20 per trade, okay? $20 per trade. So you're going to divide your 200 by 20, which gives you 10 trades, okay? Because now when trading, whoever tells you that trading you do not take losses, please go find him, slap him. If he falls down, step on him until he bleeds, okay? Because that dude just wants you to lose money and end up broke. Don't really go and step on him until he bleeds. I'm just trying to emphasize here, okay? Drive the point home that you will have losses, but if you know what you're doing over a sample size, you're not trying to win each and every trade in the market. That's impossible. What you're trying to do is you're trying to win in the long haul, a series, okay? You have given yourself a series of 10 trades, okay? At $20 per trade, you're going to have 10 trades at $20 per trade, okay? So what you want to do is you want to divide your trades into 10, just like that. Then how you're going to do this is you want to have a broker that has a wallet, okay? Your broker must have a wallet, okay? It would be better if your broker had a wallet. So what you want to do is you want to deposit your $200 into your wallet, your broker's wallet, okay? In your mind, you have done your calculations. You have your sample sizes of $20 per trade. That's it, 10 trades. So you're going to take your $200 from the wallet. You're going to send $20 to your MT4 or MT5, whichever you're comfortable with, okay? And when you put $20, which you're comfortable losing if a trade doesn't work out, that's what you want to do. Here's what you're going to do. You have that right there. So now you're working with $20, okay? You have $200 in the wallet. Okay, it's no longer 200 because you have deposited 20. So it's 200 minus your $20. Now you're left with $180, okay? $180 in your wallet. This is what you have left in your wallet. This is what you're working with, all right? So bear this in mind, all right? If this trade doesn't work out, you have 9 more trades. You're going to take the very same trade over and over and over again. Trading is repeating the very same trade, the very same criteria. Do not change it. Do not be emotional. If you're emotional, please just close this video, go and find something else to do. Go and watch a cat video. Go and watch I don't know, find something to watch on YouTube that's interesting. But trading is not for you. If you are very emotional and you're attached to your money, please, this career is not for you. So you have to detach yourself from emotions. Put money you're willing to lose, alright? Okay? If you're willing to lose it, you're going to make money. If you're afraid of losing, you most probably lose that money. That's just how life goes. You bring about the shit you're afraid of, okay? So excuse my French. I'll try and be less vulgar. So let's just move this to the side. It's still here. We have this in mind, we have this in mind. We're just moving it to the side, and now we're just going to get into how to execute Mr. D Operandi's thing. So the first thing you want to do is you want to find a footprint. What Mr. D Operandi calls a footprint, you need a footprint, okay? You need a footprint. What is the footprint? Now, with the D Operandi strategy, you do not really need to analyze the market, like draw all these crazy lines, your Fibonacci here, your wave patterns, and you name it, your bats and your sharks, and you name it, all these kinds of crazy things that people are drawing all over the market. You don't need that really. It's really simple. It's a very simple, very straightforward thing. You choose a time frame that you're comfortable with. I'm using a 5-minute time frame because I'm a scalper. My bread and butter is a scalper. I'm a scalper. I scalp the market. I have different... Let me not get into that. The footprint, D Operandi's footprint, is not my main system. I have my main system that I've been trading for years that works for me, but the way I've seen Mr. D Operandi taking heat over and over, and yet after doing my research and looking at his Instagram over and over again, I saw the consistency in him posting the very same trade setup each and every time, which to a real trader, if you are a real trader, you will realize that trading is just the repetition of the same trade over and over and over and over again. I realized that he's able to repeat the very same process over and over and over again, and that is what trading is, my friend. So you need a footprint. We're going to use hidden divergence, alright? Hidden divergence. Do not use regular divergence. There's two types of divergence. There's hidden divergence and regular divergence. Regular divergence is not what we use. Regular divergence depicts a turning point in the market. Regular divergence is also divergence where I feel like I have to teach this. I do not want to teach this. I just want to share an idea. I am not a teacher. I am making this video to share this knowledge. Not that I'm here to teach you this knowledge. I'm just going to share what I know. So please bear with me. We're going to use hidden divergence. If you do not know what divergence is, please just go on YouTube and just watch videos that explain hidden divergence and regular divergence. You know the difference between the two. So we're going to use hidden divergence, which is the continuation pattern. Hidden divergence is a continuation pattern. So this is going to be example number 1, hidden divergence. Alright, so this is example number 1. Example number 1. Okay, so example number 1 right here. That's a bit too close. Let's move this over there. I think you can see it's example number 1. So we're going to look for hidden divergence. You get to now, the first thing you want to do is you want to get to your stochastic and look for hidden divergence. If you're in a downtrend, you want hidden divergence in the direction of the trend. Okay, so here I can see this today. This is what CAD Swiss franc. Today CAD Swiss franc has been going down. So as this thing was going down, where would one want to have entered? Okay, so right here I can see hidden divergence right here. Good. I think we would have plenty of examples here of trades that worked and trades that probably did not work. So this here would have been your first footprint, which is right here. However, this footprint is a bit too steep. Now this is hidden divergence, right? This is hidden divergence, okay, where the market is going down but the indicator is doing something different. That's called divergence, but this is specifically hidden divergence. Now this footprint is about 45 degrees. It's a bit too steep, so well, anyway, let's see how this goes. So now after you find your hidden divergence, that's step 1. You look for where would you want to enter after you have seen this. This here just tells you you're going to sell. Okay, This here just tells you you're looking for sells. Now where do you want to execute your sells? You want to execute your sells where this stochastic is oversold. So we can see that stochastic got oversold somewhere here, and I'm going to mark that on the chart right there. Stochastic got oversold on that candle right there. Now on my chart, my bullish candles are blue and my bearish candles are gray. If you do not know what bullish and bearish candles are, my friend, this video is not for you. Go back, like go way back. You are ahead of yourself by too many steps. Go watch some beginner videos and find out what candles are and candle patterns and all that good stuff. So it became oversold on this candle right here. So you would have wanted to probably take a sell. No, this here was not a pattern, so you wouldn't have taken one here, because this is a bullish candle. It was oversold on a bullish candle and you're looking for sells. So this, we're going to mark this down as a false entry, which is boom, false entry right there. Go ahead and put this as red, meaning boom, you would not have entered there. You then look for another oversold region, which is over here. You're going to mark it, smooth it a little bit this way. You're going to mark that on your stochastic. Let's just mark that right there, make this green, and then you're going to mark that on the chart as well. The exact same candle that got oversold was this blue one. Another false signal. So that there's another false signal. You would not take a trade in a false signal, just wait. That there would not have been a good trade either, because you execute on a sell candle. Since you're looking for a sell, you execute on a sell candle. You will realize when you get an opportunity what I mean by a sell candle. So now you look for the next opportunity where the market is oversold again, because we're still following this very same footprint right there. Now here we are. Okay, market gets oversold right here on this particular gray candle right there. So over here, market gets oversold there. Okay, good. So now this here would have been your entry candle. It's gray. Good. Gray means it's a bearish candle. My gray candles are bearish. Okay, capish? So you now want to mark, get your horizontal line and just mark the very low of that candle. Let's make this blue. Make this blue, okay? The very low of this candle, make it blue, and then you want to mark the very high of this candle, which is right there. The reason we're marking this too, let's make this red. Let's make this red. Great. So the very low of this candle is right here. So the moment the market drops below this line here, the blue line of this gray candle, this is where you would want to execute your sell. Your stop loss would be the very same sell candle, which is right there. So you'd be a little bit, have some pips, just put your stop loss just a few pips above that very same sell candle. Now at this point right here is where you would have entered your trade, right there, and you'd have entered at full lots. All right, right there, you'd have entered right there at full lots. Okay, just mark this down. You'd have entered full lots, okay, with that leverage of 1:500. You have that leverage of 1:500. So whatever amount your broker would have allowed you to enter with, you'd have entered right there, full lots, at that leverage of 1:100. So this here would have been a failed trade, because just as you entered, the market pulled back and boom, you lost your money. So that trade would have been a flop. Your first trade would have been a loss. Great. That's yet down $20, no problem. Your first trade would have been a loss. So now you're out there again looking for another trade. Okay, this happens. Okay, this happens. There's no foolproof strategy in the market where you think you're just going to take trades and not take losses. So you're waiting, looking for your next trade. So now you go back to the beginning. You're looking for divergences. Okay, so now you're looking for hidden divergence again. So we see this here as a sell. This here is hidden divergence. The market's going down while the stochastic was going up. Okay, great. This is your second footprint right there. Okay, This right there is your second footprint right here. Now, where would you want to enter? Okay, let's call this example number 2. All right. Example number 2. Okay, example number 2, you'd have want to enter right. Now, where do you want to enter this particular trade? You have seen you're going to look for sales. This hidden divergence right there indicates you like, nigga, you are looking for sales. Right. Now, you look at your stochastic and look for where is it oversold. Right down here. That's where it gets oversold. Now you want to mark the last sell candle that gets oversold. This gray one right here. Remember, in a sell, you want to execute from sell candles. Do not execute from a buy candle. That is when you're going in an uptrend. A bullish candle is for an uptrend. A sell candle, a bearish candle is for a downtrend. So you'd want to execute on that candle. You've now made your markings. You're going to get your horizontal line. You want to draw the lowest point, the horizontal line from the lowest point of that candle. Let's make this blue, okay? And you want to mark the highest point, that very same sell candle right there. Let's make this red. All right. So when the market crosses that blue line right there is where you want to execute your trade again at full loss, and your stop loss is going to be just above that red line. The top of that sell candle is going to be a stop loss. All right, just a few pips above that candle is where your stop loss is going to be. So with that said, you would have executed on the very next candle right there. You would have entered your sell right there. Behave, you weirdo. Alright, you'd have wanted to enter your trade right there on that very same candle. You'd have wanted to enter your sells, so you'd enter it again right there, full lots. Okay, if the first trade blew your money, you deposit another $20. Okay, here you have entered full lots. Alright, and your SL, your cost of doing business. I don't like the word stop loss. It's so negative. It has negative connotations. Let's call this your cost of doing business. Your cost of doing business is just right there. Okay, cost of doing business. In case business. In case some of you insist, let's just write stop loss. Alright, so that there, that red line is going a few pips above that there is going to be a stop loss. So you'd have entered it right here. The stop loss will be right there. Full lots again, right here. That's entry number 1. Entry number 1 would have been right there. Let's make this 1. Make that red. The first entry is here. When that enters, you leave it. You wait. Watch the stochastic for another entry point. So your next entry point, you would have waited for the stochastic again to get oversold, which is over here. It gets oversold. Excuse me. Gets oversold on that candle. Maybe mark the stochastic as well. Right there. That's where it gets oversold. So your second entry would have been. Let's make this here your second entry. Okay. This here would be a second entry. That there would be a second entry. Boom. And you have to mark again where would you want to have entered when that candle closes. So you mark the lowest point of that candle right here, and then let's make this blue, okay, because that's your entry line. Okay, then your SL is going to be the top of that very same sell candle there. So you would have want to enter right there and exit right there. So now all your stop losses, which were over here, will move to down here. So your first entry secured, and you're entering down here again at full lots according to what your broker will give you, and your stop losses are going to be there. So unfortunately this trade did not work out in your favor. So it pulled back, and well, would have probably come out here, let's say a break even. Probably this here would have been a break even. Okay, so we're gonna break even. Okay, this trade here would have been a break even. Alright, meaning you would not have made money, you would not have lost money because the market pulled back against you. Alright, so that's how that would have gone. Then example number 3, let's try another pair. I like my favorite pair, my bread and butter when trading is GBP JPY. I don't know why. What's going on? Oh, GBP JPY. So this is GBP JPY, my bread and butter. This is what I use when scalping all the time. This is my bread and butter. I like to scalp GBP JPY and gold. That's what I do all day, every day. When it comes to setting a stop loss, if you want to really learn how to set a stop loss according to what the market is showing you, the correct way to set a stop loss, not the way you've been taught by a lot of mentors out there, I would recommend you go right here. Go to Jesus Christ. Go to my net is so slow. Okay. I wonder why it's so slow. Go to Raja Banks. Raja Banks. Go to Raja Banks and then Raja Banks. Oh, this is the guy who taught me the correct way to read the market. Like his market fluidity. Oh, it's the best. When it comes to price action, he teaches price action the best way possible. So you want to stop loss. Look for stop loss. How to set a stop loss. Okay, here, how to set a stop loss. You want to watch this video of how to set a stop loss. He'll teach you properly how to set a stop loss. If you really want to learn price action, because everything in this forex market, what will make you money in this forex market is the candles, right? Is basically the candles. So if you cannot read the candles, my friend, you are fucked. Again, forgive my French. I am trying to behave. Forgive me. So GBP JPY. Now, same thing right here. So you'd be looking for, this is today, you'd be looking for hidden divergence. Again, that's on the 5-minute time frame. This is example number 3, final example. I am not going to talk too much because Saliva is not stored in the market, people. Saliva doesn't come for free. My mouth is getting dry, busy talking here. I'm just here to share information, not to teach people. I'm not a teacher. I'm just sharing what I know. Okay? I'm just sharing with you people. If you guys want to know more, please dig deeper. You know, people have good heads on your shoulders. You know, just dig deep, and you can find all this information by yourself. I'm just trying to open your eyes, and so that you can see things that probably did not know were there. So I can see here hidden divergence in the morning. There was hidden divergence right there on GBP JPY. That there, and this here is going down. Okay, so I can see hidden divergence right there. Where would one want to have executed? Okay, let's mark this down. Step 1 done. Hidden divergence. Okay, hidden divergence. Hidden div. Let's not write too much. Hidden divergence. That's step 1. Step 2, where you want to execute, is when it's oversold down here. I can see it's oversold over here. So then you want to execute right there. You want to execute on that very same candle right there. So you have to mark where it is you're going to execute from. It's going to be from somewhere here. Let's make this blue, and then let's make this. Okay, let's make this red. So again, I think by now you know what the blue line stands for, you know what the red line stands for. So there is where you would have entered from. That very same candle which broke the entry point is where you'd have entered from, right? You've entered right there. Your cost of doing business. Your stop loss would have been here. Let's put that your SL, because everybody likes the word stop loss. I don't use it. I use the word cost of doing business. So your first trade would be there. You would have entered right there, full lots. Your stop loss would be there, and then that there would be trade number 1. Let's mark it. Trade number 1. You don't really, with D Operandi's way, you don't even need to analyze anything. You just look 2 minutes and you see what the market is doing, and you enter. You just enter right there. You don't even need to mark anything. So you'd have entered right there, and then you would have looked for the second trade when the market is oversold again, which is down here. Look for the candle that closes oversold first, which is over here. That's where it closed oversold first. So you'd have wanted to enter right there. So on this candle, again, you're going to mark with the horizontal line, the lowest point, right there. Let's make this blue because it's going to be your entry point, okay? And then you're going to mark again the highest point over there. That's going to be your stop loss, okay? Let's make that red. So when the market crosses below this, you enter. It's a bit too far. Okay. Crosses below that, you enter. Crosses below that, you know the deal. The market takes you out. So you'd have entered right there. That there would have been your entry point number 2, okay? That there would have been your entry point number 2 would have been right here, okay? You'd have entered right there, okay? Let's mark this. You'd have entered right there on market execution because you're entering, okay? That would have been your entry point number 2. Your stop losses would have moved from there to down here, meaning your first trade is locked, profit is locked. You're entering there again at full lots, right? And then you're holding and waiting. If the market gets oversold again, like it did right here, there, you mark it again. It gets oversold right there. Okay, so it gets oversold right there. You're going to mark this down right there. Okay, so mark that. You're going to make this blue because that will be your entry point. Okay, not purple, blue, my nigga, blue. Then when that is marked blue, you want to mark where your stop loss will be. Right there, you're going to mark that as red. Okay, because now that red is going to be your stop loss, so now it's going to be your entry point number 3. Boom. Entry point number 3 is down here. If the market crosses that red line after you enter, then all those previous trades get taken out. So on the second candle right there, you would have entered again. Right there, you would have entered. Entry point number 3. Boom. You would be in. Right there. You would be in. Okay? As it is. And then your stop loss would have moved from there to here. Market goes against you there, takes you out with the profit from there, and boom, you would have made a lot of money between here and there. And your account size being $20, here you probably would have made, let's see, from here to there on your first trades, just to see how many pips you'd have locked in with your first trade. You'd have locked in, what's this, 72 pips with your first trade. Remember, you're trading full lots. You'd have had 72 pips. Trade 1. Let's just do this. Trade 1, okay, would be at what, 72 pips at full lots. Okay, at full lots. Okay, that's a lot of money right there. That's your trade 1. Okay, that's what your trade 1. Your second trade will be from here at full lots again. You've been from there to somewhere here, which is like what, 25 pips. 25 pips again at full lots. Your trade 2. Okay, you want to mark this here. Your trade 2. 25 pips, full lots, at full lots. Okay, at full lots right there. So then obviously we'll take a little loss here.